Welcome to the Titans of Industry show. Today I'm speaking with Jordan Goodman again. I highly value Jordan's commentary, had read many of his books on debt elimination, other subjects, and we're going to touch on them today. And I think he's a very level-headed guy and is in tune with the pulse of working class America. And Jordan, first of all, thanks for coming back on the show. I have some provocative questions to run by you today.
Excellent. Glad to be on with you, Lior, and glad to help your audience. You bet.
Well, let's start with Trump. Calculated negotiator or adventurous businessman with no concern for the downside? How smart do you think he is?
He's got a negotiating strategy that works in real estate. I just don't think it's going to work in world diplomacy. So obviously the big question right now is the trade war with China. And he is approaching China like an elevator manufacturer. He's trying to put up a building, and he's pitting one elevator maker against another, and I'll get you the best deal, and if I don't get one from you, I'll go to the other guy. There's not another China to go to. Okay, you've got to deal with the ones who are there, and it's true around the world. You've got to deal with Mexico, China, Canada, and it's like there's not another alternative to go to. So he's using a negotiating technique that works really well in real estate, in world diplomacy, and I just don't think it's going to work that well. Now, I'm hopeful that with China particularly, that they'll come to an agreement. He's putting a lot of pressure on them with these tariffs. They're putting pressure on us. And it's basically could go either way, Lior. I mean, let me, for the moment, I'll put on my rose-colored glasses and say how wonderful everything is. And basically China says, okay, we're not going to steal your intellectual property. We're not going to steal your technology. We'll close down our aluminum smelters that are putting out too much aluminum. We'll lower our tariffs. We'll not manipulate our currency. We'll have more trade. The whole world will go up, and it'll be the most bullish thing you've ever imagined. That's with my rose-colored glasses on. Now I'm going to take the rose-colored glasses off. And I've been to China. I don't know. Have you been to China, Lior?
No, not yet.
So I've been there, and the big kind of psychological thing that they go through is saving face. Saving face. You can't show you're weak. You got to have a way to back down. And I say, if they're doing saving face, Trump's approach is in your face. Okay, and it's looking really hard for Xi from China to back down and look weak and cave in this game of chicken. So if he doesn't, and you see what's been happening. Trump started off with steel and aluminum tariffs, and then they responded with $3 billion in tariffs on 128 products. Then Trump responded with $50 billion, and then they responded with $50 billion, and then Trump responded with $100 billion. It's like a game of poker. They're raising the stakes all the time. There's been no backing down at all. And so if they don't, and we actually get into a trade war, this will be disastrous for world economic growth and markets, frankly. So we'll have to see. My bet is that neither side is going to back down, and we're going to have a trade war, and it's really not going to be good for the world economy, which I hate. I really want to have economic growth. Things have been going so well before all this happened. And that's what I expect is going to happen.
Well, and Ray Dalio obviously came out recently and said that trade war will lead to capital war might lead to a cyber war might be leading to a shooting war. So it's definitely something that is going to be very interesting. I want to ask you about how does the American society and economy need to reinvent itself. The boomers are retiring, 51 million people right now retired. By the end of the decade, by the end of 2030, there's going to be 81 million retirees. That's about a quarter of the country. What can millennials do to get out of this student loan mess and prosper in life?
Well, student loans are a huge problem. The average person has $38,000 in student loan debt when they get out of college. That's the average. A lot of people with 50, 100, 150,000 undergraduate. And then if you're talking graduate school, dental school, medical school, business, law, 3, 4, 500,000 on top of that. I speak to a lot of dentists, actually, Lior, and they typically have 400,000 to 500,000 in debt coming out of dental school. It's just insane. It's just this huge burden on them for like 30 years. So the millennials coming out are just tremendously burdened by this, unlike any previous generation. I can't make the debt magically disappear, but I can help a little bit. There are places where you can refinance your student loan debt to much lower interest rates. Typically, people's interest rates are 5 to 10%, if not more, depending on what's federal and what's private. There's a place called Credible, Credible. So you go to credible.com/money answers, and that's a clearinghouse for refinancing the student loans to the 2%, 2 to 3% interest rates. And there's actually not just one place, like 5 or 6 different places. You look at what's the best deal for you. And now you can combine your federal loans, your private loans, all into one at a lower interest rate. And if you're paying them off at 2% instead of 9%, that's going to save you some money and pay them off a little bit quicker anyway.
Very interesting. Now, do you think that the U.S. is in jeopardy of losing its status as the world's most credit-worthy country?
Yes, I do. We're up to $21 trillion in debt right now. And the current projections by the Congressional Budget Office, conservative, based on rosy economic scenarios, is we're going to add about $7 trillion in debt in the next 5 years, something like, which would bring us up to $28 trillion in debt. The deficits are soaring right now on both the income and the expense side. On the income side, the big tax cut that was passed in December is great for the private sector, but it means the government's collecting a lot less revenue, and it's going to continue to. This tax cut will not, so-called, pay for itself, as they said. Not going to happen, Lior, okay? It will create more economic growth, which will produce more revenues, but not enough to offset the loss of revenues from tax cuts. So that's on the income side. On the spending side, the Congress and the President passed a bill that was, I think, $1.3 trillion, $300 billion more in spending than they'd thought earlier. They got rid of the sequesters, more military spending, more domestic spending. They're going to bail out Puerto Rico. I could go through all the different things they're doing. So dramatically more spending, dramatically less income from lower taxes means the deficit is going to be much wider than people expected. And this is during an economic growth phase. When the economy turns down at some point, then the deficits really explode, because that's when you get less tax revenue and more expenses. So, $7 trillion is conservative over what's going to happen over the next 5 years or so. We could easily hit $30 trillion in debt by the end of this decade. I mean, by the end of the next 5 years or so.
Well, then I have 2 follow-up questions to that. First of all, the American dream is back, so people are back to originating mortgages. They want to take out, a 30-year loan at attractive rates before the interest rates go higher. And not only that, but they want to make sure that they can afford this house right now in today's prices, and they are afraid that prices are obviously going to go higher. What can people do to make sure that they pay off their loans faster than 30 years? That's, in any other country, 30-year mortgages are mostly non-existent, or if they are existent, then it's not appropriate to take them. I mean, it's not culturally appropriate to take on debt for so long to fund a house. But in America, 30-year loans are very, very common. What can people do to eliminate this problem in their lives and own the house free and clear before 30 years go by?
So the good news is there's a strategy called the equity optimization strategy, which literally will allow your listeners to pay off a 30-year mortgage in about 5 to 7 years on their existing level of income. And it's something bankers will never tell you about, because they don't want you to know about these kind of things. So let me just briefly describe how this equity optimization strategy works. The traditional system is you get a 30-year mortgage. You make the same payment for 30 years. All the interest is front-end loaded. The first 10, 15 years, maybe after 15 years, you might have paid back 10% of the principal, something like that. And meanwhile, you keep your income from your job and dividends, whatever it may be, sitting in a checking account, earning zero. This works really well for the banks. You're giving them your money for free, and you pay them a huge amount of interest up front. And then even more so, if you refinance your mortgage and do a new 30-year loan because the rates have gone down, you just start a new 30-year clock all over again and throw away all that interest you paid for many, many years. So this is the current system that works so well for the banks. Now I'm going to flip it so the system's actually going to work for you instead of the banks. This is why the banks will never tell you about this. So with equity optimization, you use what's called a HELOC, Home Equity Line of Credit, which is a liquid line against your house. And it's like a second mortgage, but it's liquid. You can put money in, you can take it out, you can write checks on it, you can use it, however you like. You open that as a second on your mortgage, and then you kind of use it as your checking account. You keep your income, which is normally sitting in the checking account, in the HELOC, and it's pushing down your balance every day. This is what they call average daily balance. How much do you owe today? So you're constantly making progress against your mortgage principal, and then literally over 5 to 7 years, you can have the entire thing paid off. There's a website that people can kind of find out more about how this would work, a free website called truthinequity.com. You fill out what's called a personal profile. You put in all your numbers, and it's going to say, based on what you're doing today, it's going to take you 28 and a half years to pay off your mortgage, whatever it may be. With the numbers you just gave us, it's going to be 6.5 years, whatever the numbers come out to be. Now, there are 3 things you need to make this work, Lior. The first thing, got to have equity in your house. You're underwater in your house. There's nothing to borrow against. Second thing, you need a decent credit score, 680 or higher, something like that, to qualify for that HELOC. And the third thing you need is positive cash flow. During the month, more money coming in than going out. And that positive cash flow is what's pushing that principal down literally every day. And I bet the vast majority of your listeners would have those 3 things, and therefore they would be good candidates for doing optimization like that. So it's just if it would be helpful to you, I can actually go through a quick example. Would that be helpful, Lior, to kind of show you how it would work?
I think that will be very helpful. Yeah.
Okay. So I'm going to do a very oversimplified example here. So say you had a house worth $300,000 and you had a $200,000 first start at a good interest rate at 4%, something like that. And you would take out say a $50,000 HELOC. All right. So you just open the HELOC. You don't owe anything on it yet. You would write a check on the HELOC for $50,000 towards the first. So now instead of owing $200, you owe $150. Okay. And now you owe $50 on the HELOC. Right now, you then put money in, to the HELOC. You're keeping that going, and after 9 months or so, you will have paid off that HELOC completely. So then you do it again. You write another $50,000 check on the HELOC towards the first, and now instead of owing $150, you owe $100, and then you pay the HELOC off over 9 months, a year, however long it takes. Do it twice more. You go to 50. You go to 100, you go to 0, you've now paid off your first, and then you pay off the HELOC, and you are now mortgage-free in roughly 5 years, depending on how it works out. So you're constantly making progress on the principal because your money is pushing down that principal every day. Does that make sense to you a little bit?
Yeah, for sure. Now, the HELOC, does it have an interest rate on it?
It does. It's typically tied to the prime rate. The prime rate today is 4 3/4, so it's going to be roughly 4 3/4, 5%. The interest rate may be slightly higher than your first. Say you had a first at 4, something like that. But the interest rate is not as important as the level of the activity of paying down your principal. You see, bankers have people looking the wrong way when they talk about mortgage. They say, "What's your interest rate and what's your payment?" What you should really ask them that they don't want to answer is, "How fast do I pay off my principal?" Real slow is the answer. And this is real fast because that positive cash flow is constantly pushing that HELOC down. So you just paid off, in our example, $50,000 of your mortgage in 9 months or however long it takes, as opposed to in 9 months you would have made almost no progress at all with your traditional mortgage. So it's putting your money to work for you instead of the bank. And that makes a huge, huge difference. So I've seen this time after time after time. And people's lives are literally transformed. I mean, say you're a couple that you're 35 and your mortgage is paid off by the time you're 40 instead of 65. I mean, what kind of difference is that going to make in your life? Huge.
Yeah, definitely. I want to switch gears altogether, Jordan, and ask you about U.S. foreign policy. We have Syria in the news right now. Is this an economic jolt, the type that the Bush family loved to taunt during the days of the father and the son, where they go off to war to prop up oil prices and get economic activity going in the U.S., or is this a serious mistake?
It's not about oil prices in the case of Syria. I mean, it's a mess there. You've got Assad, who's basically wiped people out into chemical weapons. Russia is now in there on his side. Iran is on his side. So Iran's trying to kind of create this bridge from Iran through Syria, through Lebanon to the Mediterranean Sea. And there's nothing we're stopping. In fact, Trump has been saying he's going to pull the troops out completely of Syria and let the Iranians just take things over. I don't think that's a particularly good move. But in this case, it's not about oil prices. It's about geopolitical moves. Trump says he's against Iran, certainly on nuclear things, but he's letting them run rampant over Syria. Between Russia and Iran, they basically own Syria at this point. And the small resistance that's there with the Syrian Kurds, they can't make it on their own, but they need our support, and we're giving them less support. So I think geopolitically we're losing in that area.
The stock market, have buyers been exhausted, or will we see new money coming in?
Well, I think we see new money coming in to some extent, but confidence has definitely been shaken. Earlier this year we had a tremendous run because everything was kicking in right. The tax reform was kicking in, unemployment was falling, earnings were coming through very solidly, deregulation was helping companies. All the things that were happening were right, and that's why we had such a big run in the market. Then starting late January, early February, things started getting a little rocky, and I think the trade war was really the big reason for that. The Federal Reserve, we know what they're going to do. They're going to raise rates another twice, maybe 3 times. I think twice more this year. So, it's like we know what they're going to do. There's not a big surprise there. But the trade war is a complete unknown. As we said, it could go either way. We could have my rose-colored glasses scenario, in which case that would be the most bullish thing you can ever imagine. Trade going up, less tension between China and the U.S. That would be a fantastic thing. Or we get into this violent trade war, not only with China, but other countries around the world, and bring the economy down. So that's the uncertainty that has the stock market so volatile these days.
Okay, let's talk about the demographics in the U.S. We have 51 million Americans right now in retirement. You got 200 million Americans in the workforce, but more and more people exiting every day. Millennials are coming in to the workforce. There's a huge shift right now. What's one of the best ways in today's world where on savings you make literally nothing? The bonds, as we know, they're eroded by inflation, and they yield very low coupon payments. Anyways, what is one of the best ways? Maybe it's off the stock market, not in the stock market. So talk about strategies that are not related to what's going on in the stock market that you would do to bank great profits without having your money at risk in the stock market, and that they take advantage of what's going on in terms of demographics and the fact that a quarter of the country is going to be basically in retirement in the next few years.
You're absolutely right, because this is a big problem for retired people, is they may have some capital, but they can't earn anything on it today. If you keep it in the bank in a savings account, a CD, a money market fund, you pretty much get zero. And even though the Federal Reserve has been raising short-term rates, the banks are raising what they're charging, not what they're paying on deposits. Okay, so the bank is not the place to make your money grow at all. And as you said, long treasuries are 2.7, 2.8, something in that range. I think rates are going to go up further into the 3s, maybe even closer to 4, because of the huge deficits we just talked about before. So you're going to lose more in principal than you're going to be earning in interest on long treasuries or treasury bonds. So here's my solution, which avoids both the stock market and the bond market and gives you a yield of 8% over a 1-year time frame with no capital fluctuation whatsoever. And that's what's called a secured real estate fund. And there's a website for that, securedrealestatefunds.com. And what they're doing, Lior, is they are lending money short term, like over a year, to high quality commercial real estate projects only in the United States. Could be apartment buildings, shopping centers, medical offices, assisted living facilities, student housing, parking lots, just all kinds of commercial properties that need the money for a short time to get their renovation done because they can't get it from the banks. The banks are still so super, super tight because of all the Dodd-Frank regulations. So they're willing to pay a higher interest rate, maybe 10% for a year to get their projects done. And then you, the shareholder, get 8% of that. The management fee is 2% on top of the 8% you get. That's what's called a preferred return. The shareholders get it first, management gets it later. And the net asset value stays at $10 a share. Doesn't move up, doesn't move down at all. The minimum investment is $5,000. The minimum hold time is 1 year. After that, you can get your money whenever you like. You can take the money in monthly checks electronically if you like, or you can reinvest it, have it compound at 8%. You can do it inside an IRA. You can do it outside an IRA. So that, to me, is the solution to what I call the saver's dilemma. And a lot of older people who are retiring have 401ks, have pensions, have stock portfolios, and they need income. And they're not going to get it from the bank these days. So that's my solution. Hopefully that'll help some of your listeners. The website again, securedrealestatefunds.com.
Now, Jordan, I want to ask you something. After World War II, the baby boomer generation started flourishing in the United States, it was the by far the most advanced country on the planet. And I remember that one of the things that was important to these people is to issue their own life insurance policy. This was a big thing those days. All the GIs came back from the war. It was a generation that everyone was brought on the fact that, hey, you need a life insurance, get a big policy out. And they probably, it's still active in America. It's still very, very common for people to have huge life insurance policies. What can people do? I mean, they pay all their lives to an insurance company, and obviously many of these policies, the majority of them, they never earn it. Yeah, they never, obviously, because otherwise the insurance industry wouldn't be so profitable. So what's kind of ways to unlock the value of an insurance policy?
So a lot of people do not know there's what's called the life settlement market, which is a way of selling your life insurance policy literally for hundreds of thousands of dollars, as opposed to letting it lapse, which is what most people do. Exactly as you say, people have been paying premiums for years and years and years, getting nothing from it. That's the way it works until you die, but most people don't die. The insurance company's actuary is a lot smarter than you are, and they have it figured out really well as to what percentage of the people are going to die, and 99% of the policies never pay off, just the way it works. So the premiums go up in many cases, so you can't afford them, or you might not need it anymore. Say you had a life insurance policy and you had younger kids to protect in case something happened to you, but now the kids are up and growing and they're self-supporting and you don't really need it anymore. What most people do, they just let their policies lapse, and they've just spent thousands of dollars with an insurance company and say goodbye. And the insurance company's real happy to get off the hook. So here's how it works. So there's a place called fundinglife.com. And what they do is they put buyers and sellers of life insurance policies together. So you would be the seller of an insurance policy. And I'll just give you a simple example. Say you had a policy with $1 million death benefit. You could sell it today for, say, $300,000. You get $300,000 right now that you can invest for your retirement. The buyers of the policy take over the premiums, they pay the premiums, and they become the beneficiary. And so when you die, they get the $1 million instead of your kids. But you got $300,000 right up front. Now they're going to do a medical underwriting on you, and frankly, the older you are and the sicker you are, the more money you're going to get. Okay, if you're 85 and you've got a heart condition, you might get $500,000 for it. If you're 70 and in pretty good health, you might get $100,000 for it, depending on what it may be. The older you are, the more chance you have of dying, and they're going to get their payoff quicker. So this is bought by hedge funds, banks, individual investors. There's more demand for policies than there are supply right now. The people at Funding Life have tremendous demand that people want policies to buy, because in their case, they're willing to wait. And so say you pay $300,000 now and you pay some premiums, you're going to triple your money. You don't know when, depends on when the person dies. So that's what's called the life settlement market. The insurance company will never tell you that that's a possibility, because they want to get off the hook. They've been getting premiums from you for years. This is their chance to get out of the contract and just run off with your money. But no, I want to keep them on the hook, get a huge cash infusion now, and then the buyers of the policy get the death benefit later.
Jordan, this is one of the most provocative investment strategies I've ever heard of. Okay, I have a last question for you. On a scale of, I wonder if if you can buy it off I won't say it on the air. So, on a scale of 1 to 10, how worried are you about robotics eliminating jobs in the U.S., mundane jobs?
4. I'd say 4. I mean, it's definitely eliminating some jobs, but my real life experience is that it creates other jobs. For example, Amazon has all these warehouses. They actually bought a robotics company, and there's a lot of robots floating around there moving all the packages in various ways. But they still hire a lot of people. Okay, so even though there are robots there are other things that robots can't do. Typically, robots do things that people either can't, like it's too heavy, do or don't want to do, like painting a car where it's really noxious, toxic chemicals, that kind of thing, or go in the middle of a nuclear reactor and change the rods. This is not something an individual is particularly good at doing, but a robot's great at doing it. right? So robots can do things that people typically either can't or don't want to do. And I think they're, good in many cases. Now, some areas, I'll give you an example. Elon Musk's solar plant out in Nevada. It's one of the largest factories, and they're making all these batteries, okay? It's a huge, I think it's like 5 million square feet. And there's like 5 people working the place because it's all done by robots. Now, in the past, that would have been thousands of employees. So there's no question robots are going to take some jobs, but I'm not as concerned about it. So automation clearly is taking jobs from people, but new jobs are always created as well. You can't be kind of looking, to try to revive the buggy whip industry or something. It just doesn't work. Progress moves on, and capitalism makes things more efficient. That's just the way it works. So I think we're going to lose more jobs to automation than outsourcing in the United States. And we've lost some to China and Mexico, but if you look at the numbers, I think ultimately we're going to lose more actual jobs as machines and robots come in and are able to do things that individuals did in the past.
Jordan, where can people find out more about your work?
My website is moneyanswers.com. Love to help people, take emails from people. Got some from last time. Lots of resources of all types, videos. I've got a channel, a YouTube Money Answers channel. So love to help people with all aspects of personal finance. Hopefully we've touched on some things today that will help the folks.
Jordan, thank you very much. We'll definitely have you on again. Very provocative ideas, and I love the fact that many of these ideas are outside of the stock market and are just helping people with personal life savings. So definitely thanks for coming on the show, and we'll see you next time when I'm a guest on your show.
Excellent. Thanks so much, Lior. Appreciate it.